What does a one-day 1.04% jump in Canadian stocks really signal, and how should you position now? If you invest in Canadian equities or ETFs, today's move offers a clear read on shifting macro expectations. The S&P TSX Composite closed up 1.04%. That ended a stretch of range-bound trading and told us risk appetite improved. The catalyst was a reset in rate expectations alongside fresh earnings updates. Investors are weighing inflation paths and central bank signals on both sides of the border. The Fed targets 2% inflation. The Bank of Canada targets a 2% midpoint inside a 1 to 3% band. Those anchors shape policy rates, and by extension, equity discount rates. When the path feels steadier, equities can breathe. Here's what changed beneath the headline. Sentiment firmed as the worst-case inflation fears faded. Pricing now reflects a more balanced outlook on rates instead of tail risk scenarios. Earnings helped, too. Company updates gave incremental clarity on margins and demand. That made it easier to separate resilient balance sheets from cyclical names. Cross-asset tone was healthier. Equities did not rely on a single macro driver, which supports diversification rather than one-way trades. Why it matters for your portfolio: the TSX skews toward financials and energy, which often represent more than half the index. That concentration means shifts in rates, commodities, and credit conditions can move the entire market fast. A 1% plus day is material for benchmark allocators. It can flip month-to-date performance, trigger rebalancing thresholds, and open dispersion across more than 200 constituents, especially in earnings season. So how might different investors respond? Long-term low-cost index investors can stay the course, but check whether financials and energy weights still match risk tolerance. Factor and dividend seekers may lean into quality balance sheets, consistent free cash flow, and pricing power as earnings dispersion widens. Active stock pickers can sift for companies showing margin resilience and manageable leverage as rates stabilize. ETF users can consider core Canadian exposure, complemented by sector or factor sleeves to fine-tune rate and commodity sensitivity. And for risk management, ensure diversification beyond single macro bets, because today's breadth suggests multiple drivers are in play. Bottom line, a steadier rate narrative plus constructive earnings signals argue for staying invested, focusing on quality, and using diversification to navigate rotations. Read the full article at finlitica.com.